Dr. Cherry here. Hope all is well with you. Welcome back to the Life Money Balance podcast, where we let your life lead your money, not your money lead your life. We're back to chop it up with one of my great friends, Christine Benz. She is a legend when you talk about Morningstar, which is all things investments and personal finance. And Christine Benz is dropping mics on all of this key information that impacts financial journeys. She is the director of personal finance and retirement planning over at Morningstar. My friend, Christine Benz, welcome.
Preston, it's lovely to be here. It's an honor. Thank you so much for having me on.
Yes. And we did some podcast swapping.
Yep. You were on our Morningstar podcast, The Long View, which was awesome. We talked about a lot of different dimensions of financial planning and had a great conversation.
For sure. And for those that you're listening, tune in to that. We usually do that at the end of the show. Christine is like, where can we find you? We'll do that anyway.
Okay.
But, but the Long View Morningstar podcast is something that everybody needs to be tuning into, and also reading anything Christine writes anyway. But we'll drop that in the show notes. But today, we find in the news, and people ask all the time, because we're talking to the consumers and a lot of folks that are in the wealth accumulation stage, Christine, we have these retirement accounts. We hear the word retirement a lot. I guess that's a pun because you're a retirement planning director. And we have all these different accounts. That said, when you're in the wealth accumulation stage, retirement accounts can be somewhat confining and restricting sometimes. And folks are having these lives during their accumulation stage. They want to do other stuff.
Right.
They want to optimize life later and maximize retirement. Well, I guess you would say optimize life now and maximize retirement later. So let's unpack that a little bit. We have all these different accounts. What's your take on modern retirement planning and living life now?
Yeah. And I feel like this often gets glossed over, Preston. People assume everyone's single-mindedly saving for retirement. And we don't really talk as much about those short and intermediate term goals along the way, which we inevitably have throughout our lives. And so, I often say if I'm talking to a group of young accumulators, like people in their 20s, for example, I'm like, okay, so chances are you're multitasking. You may be paying down debt. You probably have a set of short and intermediate term goals, whether paying for a wedding or a home down payment, or even just, a big vacation, or maybe you get a sabbatical from work or something like that. And then you've got retirement. And a lot of folks at that life stage kind of back burner retirement. I think it just seems hopelessly abstract. Like, why am I even worrying about my 60, 65-year-old self? So I do think you need to focus on saving for those short and intermediate term goals. And one reason I'm such a believer in thinking about them, quantifying them, articulating them, is that I've found that once people hit a short-term goal and, maybe they do make that home purchase or whatever it is, or maybe it's something smaller, it is just a really empowering thing that gets them on board with the value of saving, because you're deferring gratification, which is a big ask for people.
Right. Yeah.
But I love the idea of articulating those short and intermediate term goals, saving for them, and hitting them, because I think once someone does that, then they're on board with being financially well overall. The question is, like, where do you save for those short and intermediate term goals? And in my mind, and I don't know, maybe you have your own take on this, Preston, but I think, obviously, like, a taxable brokerage account is going to give you the most flexibility to pull the money out without any strictures, to invest in whatever the heck you want, for good or for ill,
Right.
So whether that's Bitcoin or whatever the case might be, or maybe something just basic like a total market index fund. But the brokerage account gives you a ton of flexibility, and it also gives you kind of decent tax treatment in that when you pull the money out for whatever goal that you have, you will owe capital gains on the difference between what you put in and any appreciation that you've earned. So
Mm-hmm.
the capital gains tax, of course, is lower than ordinary income tax. So I would start there. Lots of flexibility, no limits on how much you can put in, no strictures on withdrawals. Another idea that I like to talk about, especially for those very young accumulators who are just kind of getting their plans off the ground, is using a Roth IRA as kind of a
Mm-hmm.
multitasking vehicle. So ideally, you would save and save and save in a Roth IRA and not touch it until retirement. But as you know, Roth IRA contributions can come out tax free and penalty free for any reason whatsoever. So I think of it
Mm-hmm.
as a really nice training wheels account, gives you a ton of flexibility. It's also a place potentially if you're building an emergency fund where you could stash some funds there. So I like to think
Mm-hmm.
about those vehicles as good vehicles to augment your dedicated retirement savings vehicles.
Right, right. Oh, wow. You hit a lot of good touch points right there, particularly for young folks because they have a lot of time. When I talk to a lot of folks in their high income years, and maybe the Gen Xers or, in their 40 to 57 area, they're trying to catch up in these areas and they find they want a little bit more flexibility. They want to participate in Roths. They have 401ks at home and they're saying, or at work, excuse me, and they're saying, okay, how do all these inter interact or intersect? So I want a little bit of flexibility. I do want to save for retirement and I do want tax free, but I earn too much. So how does that work? And we do know that we heard this thing called mega backdoor
Right,
Roth and all that, right?
right.
So let's unpack that a little bit too, because that's a great strategy.
Yeah, definitely. And, I like the idea of people at that life stage that you're talking about kind of thinking about doing all three of the major account types. So you would have your traditional
Mm,
tax deferred, your Roth, where you're putting in after tax dollars, but getting tax free withdrawals in retirement, and then that taxable brokerage account. I think you should be putting a little bit into each of those. And the idea is that you're obtaining tax diversification. So a lot of people, like people at my life stage, I came of age in an era where there weren't actually Roth 401ks. It wasn't an option. So I
mm,
probably spent a good 10 years, maybe even 20 years, putting funds in a traditional 401k. That was my only option. So now, even though maybe it's not ideal for me to be funding a Roth 401k at my income level, I just want to have some funds in retirement that I'll pull out without any taxes and also without any required minimum distributions. So I like that idea of tax diversification where you don't really know what your tax rate in retirement might be. We don't know what might happen to tax rates secularly, right? Like even if we
right.
try to
Yeah. Yeah.
optimize this and figure out, well, I think I'll be, if we hold today's tax rates constant, maybe I'll be in this sort of tax bracket in retirement. But we don't know, that Congress can change the tax code. So I would
Right.
hate to see people come away with this sense of like false precision about the right account to fund. I like the idea of doing each of those three. And then you also mentioned kind of an ancillary account type, which is after tax 401k
Mm,
contributions, which we're
mhm,
eligible to make. I think a lot of people are familiar with kind of the baseline 401k limits, which I think is 22.5 for people under 50
mm.
and 30,000 this year for people who are over 50. But there's also this much larger number, and I don't know what it is off the top of my head, but it's close to like it's over
66 or
60,000.
something like, yeah,
Yeah,
yeah, something like that. Yeah.
that's how much you can put into a 401k all in. So that includes
Mm,
your own contributions, employer matching contributions, forfeitures, and it also includes what are called after tax contributions. And I know there's a lot of
mhm.
confusion about, well, what are these after tax contributions and how are they different from Roth 401k contributions? Because those kind of seem like they are after tax.
Yeah,
But
right, right.
the key difference is that you're putting in these after tax contributions, and the money the account doesn't become a Roth account until until you convert it somehow.
Mhm.
And the good
Yeah.
news is that more and more plans that are offering after-tax contributions and allowing after-tax contributions also have this in-plan conversion feature. And many times it's an
Mm.
automatic in-plan conversion feature where you just check a couple boxes. So you're putting in after-tax dollars, and then without you lifting a finger, the account gets converted in plan to Roth. I've been doing
Right.
that for the past couple of years since Morningstar began offering that feature. And it's just a great way if you're kind of a aggressive saver, or maybe you feel like you're making up for lost time, if you're playing a little bit of catch up. It's just a great
Mhm.
way to fund a 401k to the max. The key point, though, is that you need to have a good 401k. Like, you don't
Oh,
want to be
yes.
funding any old crummy 401k. So if your 401k is high cost, if it has high operating expenses or lousy funds or whatever the case may be, you probably don't want to do this. You probably would want to use some
Mhm.
other account type. But one thing I've noticed in just observing people's accounts, 401k plans, is that oftentimes when you have all these creature comforts like the ability to make after tax contributions and, in plan conversions and so forth, oftentimes that's a good plan underneath the hood too, that you have good
Yeah.
investment options, you have very low administrative expenses. Not always, but oftentimes that's the case.
Yeah, for sure. And you hit, oh my goodness, you have so many points there. 401k is particularly for the accumulators right now, that in that life stage, in that kind of Gen X stage. Uh, that is it's been the lifeblood
Mhm.
for a long time and still is,
Yeah.
as far as funding to the max, if you have that capacity, and funding to the max. I mean, there's your employee max, but then there's the all in, like you said, and taking advantage of those. And you hear a lot of noise in the media about 401 being scams and all this. I know some of them are high cost, but there's a large portion of 401ks that are cost effective, and then you have self-directed accounts that you can move your money and have more investment choices. And then on top of that, you're getting a tax break on your contributions and tax deferral. So, yes, you're paying ordinary income on the back end, but look at all the advantages you received in the middle and in the beginning.
Absolutely. And
Right.
the key one is just how darn easy it is to contribute to a 401k. I think that's like the key impossible to ignore benefit, is that oftentimes people are automatically defaulted into the plan. I mean, you're
Mhm.
typically defaulted into a target date fund, which people might quibble about too. And we have a lot of debates on Twitter about like whether they're good, but most of the big entrenched providers are fielding pretty good target date funds these
Mhm.
days. And so it's pretty goof proof for people who have a good quality
Mhm.
401k. I will say though that the 401k marketplace is super bifurcated by employer
Mhm.
size. So the big companies
Yeah.
are fielding gold plated plans, and that they
Mhm.
they might even have like a dedicated team that is doing due diligence on the plan and monitoring participant behavior, and they've got all the bells and whistles. And then smaller employers just have a lot of
Right.
other things going on oftentimes. They're
Right.
not necessarily savvy about what they should be looking for in terms of 401k providers. Sometimes a provider might come along and offer to offset some of the employer costs by sort of offloading costs onto participants. So there's a lot that can happen with small employers that make their plans subpar. That's what I hate to see, is that we just do
Yeah.
have a very bifurcated marketplace, and people working for small employers sometimes get the short end of the stick.
Right. And then, I mean, that's where you could, folks can probably take advantage more of that, even though more than likely you could use all three, your IRAs, your and your employer based accounts and this. But yeah, you can take advantage of that taxable brokerage account right
Totally.
there. Yeah,
Totally.
you have a lot more freedom there. And there's some other bells and whistles back to go. And let me back up, because you touched on like the target date fund
Mhm.
and the automatic enrollment. So let's climb that mountain a little bit too, about really the behavior and the emotion part of it and the mindset. Those are a lot of, barriers, natural barriers for many folks. And if the more that we can remove those from people, or help, help remove those, then the higher probability people can accomplish their goals. And a target date fund is, it moves with diversification and risk tolerance as you age, and it moves along with that. So it's like, okay, because people ask all these questions: how do I invest? What do I invest in? And then with an automatic enrollment, you're placed in there,
Right.
right? Because a lot of people they forget. So let's unpack that a little bit, Christine. I mean, these plans help people get to where they want to go.
Well, absolutely. I mean, when I think about the key innovations that have helped investors over my career, I think of, well, index funds. I'm a boglehead, so index funds would be near the top of my list, and corollary would be exchange traded funds. But then some of these automatic features, some of the nudge features that came out of the great work that Richard Thaler and Cass Sunstein did in their book Nudge, and that really came into being in 401k plans through automatic enrollment, auto escalation in some cases where you get nudged up in terms of your contribution if you get a raise. And then target date funds, I would say, would be the third major innovation that has just been a grand slam for investors, just in terms of simplifying the process for people who come into this not knowing a stock from a bond. And that is many very smart people who have other jobs doing other things do not have that basic awareness. The target date fund takes that decision making out of their hands and eliminates the possibility that someone would come into a 401k menu and maybe have 10 choices and just put 10% in each,
Right.
which we used to see, and I think we see a lot less. So target date funds aren't perfect. Some of them are high cost and maybe have lousy underlying funds, but the ones that have gained market share are the good ones. And they're mainly the ones that are composed of index funds that use very inexpensive building blocks to populate the portfolios.
Right. And keeping up on the kind of the behavior part and what we're hearing in noise in the media a little bit, and maybe in some advisors, I share with folks all the time the R in individual retirement account is retirement.
Right.
So I know that, and it's not for restriction, but it is in a little bit. The rules or the boundaries a little bit that are set in there are for our own good a little bit, so we won't be tapping into those funds too early for our retirement, and allow for that compounding to grow. So we won't be pulling out of those funds, and let that money grow. So when we get ready for our future lives, it should be there when it's needed.
Yeah, I think that there's been a lot of debate in Congress over the years about what sorts of situations we'd want to let people have access to their funds without penalty prior to retirement. But yeah, that's the basic bargain that we strike in exchange for these tax breaks. We're kind of tying our money up. And it turns out that tying our money up is a pretty good way to invest. Like if we are just socking our funds away and don't spend a lot of time monitoring them, certainly aren't pulling the money in and out or moving it around, switching it among different investment products, that redounds to the benefit of our plan. That I always say, a policy of benign neglect of your investment plan is much better than one that's too active and busy. And I worry, I talk to a lot of people who are very engaged with their investments. And I worry, are you too engaged? Are you too busy with this stuff? Sometimes that doesn't generate a great outcome, oftentimes.
Right. Yeah, oftentimes, sure. And also, and to move a little forward, yes, like you said, should we strike that bargain for those in exchange for the tax deferredness and some of the bargains that we receive, as far as tax and compounding and whatnot? That's what the R is for, a little bit of restriction. That's why we do partner up with the taxable brokerage accounts and the Roths of the like, right? And so when we talk about finding flexibility with our accounts, we can attain that. We can attain that with those, because that taxable brokerage, it does have a sense of, okay, I got a little bit of freedom here, have a little bit of flexibility, have a little bit of control. I can use it for multiple things. And then also too, it may expand the opportunity set, all of that. So let's unpack that a little bit too. You do have the opportunity. So it's not, and I came up with a term, and notters. And they'd be like, what is that? Is that an alien or a rugrat or something like that? I said, no, it's and not or, So use your retirement accounts and then supplement with the brokerage. What do you say about that?
Yeah, no, I think that's a terrific idea. I like the idea of people at least thinking about what their use of what their plans are for these funds and investing accordingly. So if they have some sort of short or intermediate term goal, obviously you'd want to invest that money pretty conservatively. You don't want it in the same sorts of long-term investments that you'd have earmarked for retirement. So I like the idea of kind of setting up that taxable account to align with whatever your plans are for it. If it's all retirement, well, then maybe it's just, some sort of tax efficient portfolio, maybe, plain vanilla index funds or something like that. But
you can, and also too, Christine, you have generational wealth, because you have the step 2 effect with the taxable brokerage account. You have different, you can, college planning. You could because not when you have type of 529s and all this other stuff, not everything is going to be paid out of a 529.
Right.
So again, that's where you have those flexibilities in order to do this or that. And to your point, and I love the word, which is alignment. That's why a lot of people ask me, it's like, well, what does money psychology have to do with the money numbers? And I said, well, everything, because if you don't have any alignment because I've heard you mention that a couple of times, then you have no direction with how you want to choose your investment house, your direction of your financial plan. So money alignment, isn't that a huge part of it?
Absolutely. And, I'm a big fan of this whole idea of bucketing for retirement, where you're sort of thinking about your spending in retirement and investing in line with your anticipated spending. So if you're already retired and you have spending coming up and you'll need to be withdrawing from your portfolio, well, you don't want to be taking any risk with that money, right?
Mm-hmm.
Because that is your near-term spending. So you'd want to have it in probably FDIC insured cash instruments, because yields are a lot better today than they were a couple years ago, and you're kind of just battening down the hatches. But I think this bucketing concept can be useful for people who have shorter term spending goals as well. So if I'm someone who is, maybe targeting a home purchase, for example, well, I have no business being in long-term investments with that, unless I don't plan to buy the house for another 10 years. I have no business being in stocks with that portion of my portfolio. I need alignment by investing in something that is fairly short term, because if I find my dream house next month, I want my money to be there. I don't want it to have dropped, 20% or whatever could happen to a stock portfolio.
Right. What do you, that bucketing approach? I might have to have you back on talking about the bucketing approach. Oh my, and then there's a certain audience that would remember Bozo the Clown, because every time I hear about bucketing, I'm throwing the little ping pongs in there. Oh man. Yeah. So yeah, let's unpack do you think, the backdoor Roths or the Roth conversions are overdone? Because you talked about we don't know
Mm-hmm.
what the taxes are going to be in the future. And I think that some activity in this area is overdone because I'm going to say it, the tax tail is wagging the dog a little bit. And everybody likes having these tax conversations, but it's about tax diversification, not necessarily knowing what the tax number is going to be.
Yeah, no, I think people can put too fine a point on it and sort of, I mentioned before deriving this sort of false sense of security or false sense of precision about their plan, because taxes do remain a wild card. I mean, I remember even I guess it was 2003, dividends were taxed at the ordinary income tax rate. Things change with the tax
Mm-hmm.
code. And so the beauty of tax diversification is that you're not perfect, but you are
Mm-hmm.
equipped for almost anything. I do like the backdoor strategy where you're making those
Yes. Yeah.
traditional IRA contributions where you can earn a tax deduction on those traditional contributions, but you're contributing after tax dollars and then you're converting shortly thereafter. And the key reason is that I think for a lot of folks, especially higher income earners, they just need that additional silo. Even if it's only
Yes.
$6,500 a year, they need that slot. And it's a way to amass some assets that will be tax free in retirement. So for people who are in the position to take advantage of, higher income folks who are in the position to take advantage of that backdoor Roth contribution, I think they should keep doing it.
Mm-hmm. And this is where we have, and this is why the reason for the show, and is having that, finding that retirement portfolio flexibility, or even your investment portfolio flexibility, is having that. The diversification is a key word.
Mm-hmm.
I mean, I guess that's why I'm a fan of Skittles. I mean, because you have
yellow, orange, red.
yeah, right, because you have that. Well, we're coming up on the end of the show, Christine. When we're talking about this, finding some flexibility in your portfolios, retirement portfolios, your investment portfolios. What haven't we discussed today that you think folks might be missing out on a little bit?
Well, one thing, Preston, when you said, diversification is so valuable, I think one thing we don't talk about enough is just how diversification is kind of a form of humility. I think that it's a way of saying, I do not know what is going to happen
Mm-hmm.
with taxes, with the stock market, with the bond market, with the economy. And so we diversify like in so many different ways to effectively say that. And
Mm-hmm.
I think that savvy experts should be saying, I don't know all the time. And
Mm-hmm.
coming at this with a sense of humility, and so you'll never get things exactly perfect if you're being humble and if you're diversifying, but you will protect yourself against kind of a huge swath of outcomes. So the longer I do this and the more I think about this stuff, the more I think humility is so important. And the best way we do that is by just diversifying and setting ourselves up for any number of potential outcomes in our lives as well, right? We don't
Right.
know how
Right.
long we'll live. We don't know the fortunes of our jobs. There are a lot of things we cannot forecast. And so it's wise to just kind of set up a plan that is flexible, it's diversified, and considering humble a good word.
Oh, wow. Oh, you know what? I might get some humble pie when I go downstairs. Yeah. Thank you for dropping that knowledge, Christine. I
Thank you,
appreciate you
Preston.
stopping by our show. I know our listeners appreciate you. We led the top of the show where to find you, but let's go over it again. Where can everyone find your knowledge?
So I'm on Morningstar.com all the time. You probably more than people care to see me. I'm there like every day, writing articles and doing videos. I'm on Twitter, and you and I are Twitter pals.
Yes. Yeah.
Christine_Benz is my Twitter handle. And then I have a podcast, which you so kindly referenced. It's called The Long View, and I do it with my colleague, Jeff Patak. It's an interview format with great thought leaders like you. And it's called The Long View, and people can find it on any of the usual podcast outlets.
Awesome. Well, thank you for stopping by. I really appreciate
Thank
you.
you, Preston. Thanks so much. It's been an honor.
Yes, yes. All right, listeners, that's another show of the Life Money Balance podcast where we let your life lead your money, not your money lead your life. Thank you for tuning in. We'll see you next time. Chop it up.